The stock market is hitting new highs, optimism is through the roof, and yet Warren Buffett, arguably the greatest investor of all time, is sitting out. He's been selling billions of dollars in stocks, trimming his biggest holdings, and piling up an unbelievable $300 billion in cash. So what gives? What does Buffett know that the rest of us don't? Is he waiting for the right moment, or does he think this rally is too good to be true? In this video, I'm going to show you the pattern Buffett might see, why he's playing it safe, what his most recent sold and bought stocks are, and most importantly, what his strategy means for your investments. Okay, let's get into the most informative details. What exactly is Warren Buffett doing with his portfolio? Well, let's just say the Oracle of Omaha has been making some moves that has Wall Street buzzing. His latest 13F filings and Berkshire Hathaway's Q3 reports paint a pretty clear picture. It's a season of selling. Let's start with a headline grabber, Apple. Buffett sold 25% of Berkshire's Apple holdings in Q3 alone, which translates to 100 million shares. Yes, 100 million. That's roughly $20 billion worth of stock sold. And it wasn't a one-off. Earlier this year, he sold almost 50% of his Apple shares in Q2. Apple still makes up 26% of his portfolio, so while he's trimming, he's far from ditching it. Clearly, it's about profit-taking, not losing faith in the company. Now, Apple wasn't the only stock to get the axe. Bank of America saw a 22.77% reduction. Over 235 million shares sold. Then there's SiriusXM, Charter Communications, and NU Holdings, all of which saw significant cuts too. As for Liberty SiriusXM or Floor & Decor, don't bother. He's completely exited those positions, poof, gone. But it's not all about selling. Buffett's been handpicking some stocks too, just not on the same scale. He picked up shares of Domino's Pizza and Pool Corporation in Q3. Earlier this year, he went big on SiriusXM Holdings, increasing the position by over 260% in Q2 before trimming it back in Q3. So yeah, he's buying, but it's cautious and targeted. So here's where it gets really interesting. While trimming his stock portfolio, Buffett has been moving mountains of cash into short-term US Treasury bills. I am talking about $288 billion in treasuries, up from $129 billion just last year. That's more than double. Treasuries are basically the investing world's version of a safety net. With interest rates around 5%, they're low risk and actually paying off for once. So what does all this tell us? Buffett isn't acting randomly. Why is he cutting loose some of his biggest holdings, including Apple? Buffett rarely does anything without a reason, and his recent selling spree seems to be about three key things: overvaluation, fiscal concerns, and opportunity cost. Let's start with Apple. It's not that Buffett doesn't love the company. He's called it one of the best businesses he's ever invested in. But even the best companies can get expensive. When Buffett first bought Apple in 2016, its price-to-earnings ratio was 12. Meaning investors were willing to pay 12 times the company's earnings for its stock. Today, that PE ratio has ballooned to 37. This means Apple's stock price has shot up way faster than its profits. Buffett's philosophy is simple. He doesn't want to overpay. Even with Apple's massive success, he knows the current price may not deliver the same kind of returns in the future. So he's locking in profits while the market is still willing to pay a premium. And here's the thing about Warren Buffett, he doesn't just look at companies, he's looking at the big picture. And right now, that picture includes a US government with a huge fiscal deficit and a growing debt pile. Buffett's been pretty vocal about this. He said that corporate tax rates, currently at a historically low 21%, are likely to rise. Think about it. If the government decides to close the deficit by hiking taxes, companies like Apple could see their earnings take a hit. By selling now, Buffett can lock in gains at today's lower tax rates instead of paying more later. And it's not just taxes. Rising interest rates, stubborn inflation, and global economic uncertainty all add up to a less than rosy outlook for stocks in general. Buffett isn't panicking, but he's definitely being cautious. To top it off, he isn't just selling to sit idle. He's putting that money to work in US Treasuries, which are currently yielding around 5%. For Buffett, this is a no-brainer. Why risk holding onto overvalued stocks when you can earn a solid low-risk return by parking your cash in Treasuries? But there's another reason for the cash reserve. Let's talk about the elephant in the room, or rather, the $300 billion mountain of cash Warren Buffett is sitting on. What is the deal? First off, Buffett isn't new to this whole cash hoard game. It's a classic Buffett behavior. Remember the 2008 financial crisis? Before the market tanked, Buffett was sitting on a pile of cash, waiting for the perfect moment to pounce. And when the crash came, he swooped in and bought deals on Goldman Sachs and other big names for pennies on the dollar. In Buffett's own words, cash is a call option with no expiration date, meaning holding cash gives you the flexibility to act when the time is right. He's not rushing to buy overvalued stocks. He's waiting for the kind of opportunities that only come when the market's in meltdown. Fast forward to today, and we're seeing a similar pattern. Buffett isn't parking this cash out of fear. He's doing it because cash is actually working for him right now. With US Treasury bills yielding over 5%, cash isn't the drag it used to be. Think about it. He's earning a solid risk-free return while sitting on the sidelines. But there's more to it than that. Buffett's cash position suggests he's seeing warning signs in the market. Rising interest rates, geopolitical tensions, inflation that just won't quit, and an overheated stock market. All of these are making Buffett hit the brakes. So what does this mean for the market and the economy as a whole? Because let's face it, when Buffett makes major moves, like selling billions of dollars in Apple shares or stockpiling $300 billion in cash, it sends a major signal to the market. For example, the tech sector has already felt the heat. Apple stock dipped after news of Buffett's big sell-off. And since Apple is such a giant, its movements tend to drag the entire sector with it. Investors see Buffett trimming his position and start wondering if they should follow suit. It's a domino effect. But it's not just about Apple. Buffett's broader reduction in equities signals caution, and that can influence market sentiment. If one of the world's most famous investors thinks stocks are overpriced, people start asking, should I be worried too? Buffett's shift to US Treasuries and cash signals that he thinks the market is overvalued and that the current economic environment is shaky. Rising interest rates, inflation, geopolitical tensions, it's all adding up to a market that feels a little frothy. But does this mean a crash is coming? Not necessarily. No one can predict the market. Warren Buffett himself said, "I never know when a market will crash." But here's the beauty of Buffett's strategy. He doesn't need to predict the market. By holding cash and focusing on safe, income-generating investments like treasuries, he's positioning himself to act when opportunities arise, whether that's tomorrow, next month, or next year. The question is, what should you do? Buffett's actions don't mean you should sell everything and hoard cash, but they do suggest it's time to take a hard look at your portfolio. Are you chasing overvalued stocks? Are you prepared for market volatility? Remember that Buffett's strategy works for him. He's managing a massive portfolio with billions of dollars in resources, and his decisions are based on Berkshire Hathaway's unique position. What works for Buffett might not work for you, and that's okay. A good rule of thumb is, don't pay more for a stock than what you believe it's fundamentally worth. Want to find the most undervalued stock opportunities right now to invest in? Click the video on the screen to find out.